Hello, I'm Kurt. I'm a value investor, and I love to buy stocks at prices below their intrinsic fair value. Today I'm going to do a discounted cash flow analysis of Sprouts Farmers Market, show you the results, do a deep dive on their financials and the quality of their business. So without further ado, let's get into my analysis of Sprouts. Okay, so let's get into our stock valuation and analysis of Sprouts Farmers Market, ticker symbol SFM. I have some key takeaways here to start out with, and the main takeaways are this: still the stock is slightly underpriced. The share repurchases have remained strong after quarter four of last year was a little bit of blip of increase in shares outstanding. They resumed the aggressive share repurchases in quarter one of 2023. They also had record revenue per share based on that share repurchase strength in quarter one of 2023. And the store openings are continuing. They're plus 4% in number of stores year over year. So I think they've added dozens of stores, maybe somewhere around 30 stores in the last year or so. The company remains good value, especially for the type of business it is, but it's close to its sell point, so it's getting close to that fair value range. It's not severely underpriced, but maybe slightly, but it's time to start watching for a good sell point and exit point. The business is resilient, and I think it has a great management, fantastic CEO, and we'll look at a little bit of that in a couple slides. So just to keep in mind, the principles of valuation that we use is, first of all, to always look at per share metrics. So we want to make sure that the shares outstanding is not increasing, that the company is not growing by issuing new shares to raise capital, because that dilutes current shareholders. Decreasing share count is actually positive. We always look at free cash flow as our main metric. Free cash flow is the money that's left over for investors. It's cash from operations minus capital expenses. So net income is close to free cash flow, but of course from net income, the company has to take some of that money and invest it back into the company to make sure it continues to grow. The shareholder doesn't have access to that money. That gets burned through capital expenses. So we look at free cash flow. And of course we have to discount the future earnings, the future free cash flow, to present value. So we have to adjust for the time value of money, and we have a 10 to 15% return target, so we use a 10 to 15% discount rate. We sort of have a range of results in that window that tell us, based on that perspective, is a stock priced under value or above value, above intrinsic value. Lastly, we want to look at healthy fundamentals. So we have a pillar system that assesses the company, how sturdy it's been, how consistent it's been, the predictability of the future income and the future free cash flow, the quality of the business, the balance sheet, healthy accounting, and all of that. If the company checks out on our pillar system, that means it has those healthy fundamentals that allow us to forecast its future free cash flow very well and with reasonable certainty. So let's get into the business overview of Sprouts Farmers Market. Sprouts is a grocery store chain, and it has a niche in the health foods segment, and it focuses on healthy produce, organic foods, and stuff like that. So people who have special diet programs and special diets, they go to Sprouts, and they know that most of the products at Sprouts Farmers Markets are your gluten-free, your organic. So if they value that a lot, they go to Sprouts rather than to the discount grocer, knowing that it's going to be a lot easier for them to shop. It's a much cleaner and nicer grocery shopping experience, probably. That's part of their business model. It's a little bit more expensive, but it really caters to those special shoppers, those special consumers. They have 395 stores in 23 different states, and they have an expansion growth model. They've continued to add stores in recent years, and that seems to be what they want to do. They take their free cash flow, they open new stores in places they think will do well, and they keep the money rolling. Their major competitors are obviously your typical grocery chains. They are trying to attract people from the typical grocers to go to their slightly higher priced store. But in the niche category, their competitors are like Whole Foods Market and maybe a couple others, like Trader Joe's is one of those experiential grocery stores, and that's the space that Sprouts is in. But Whole Foods has a lot of the same products and product types as Sprouts, so that's one of their niche competitors, whereas the typical grocer is the general competitor against Sprouts. Sprouts has a market cap just under 4 billion, which puts it right in that small to medium cap, and they have their price is currently is $37 a share, and their price to earnings ratio is just under 16, between 15 and 16. The company does not pay dividends and instead relies on that expansion growth model that we talked about, adding new stores. Just a couple images here to show you, give an image of what's going on with Sprouts. So this shows the number of stores in each state, their expanding markets and their existing markets. This came from their Q1 results from 2023. It's their most recent data. They put a little newsletter out, so you can go find this. But of course, they have tons of stores in California and in Arizona, and they're expanding in Texas. So when you think of health food and the health food movement, yeah, on the West Coast, it's going to be a lot bigger. But they're opening up stores in Florida and Georgia as well, and they're starting to crack into that Northeast market in the Maryland, Pennsylvania, Delaware, New Jersey area. And they have distribution centers and they have connection with local grocers in these states. And that's a big part of their model, is that they have, for their produce, as much as they can, ties and connections, and they source their food from local farmers. So that's a really nice and interesting part of their business model. Here's just some images of the inside of some of their stores. I just pulled these right from the web. You can see that Sprouts relies on a bright, organic feel, produce-centric grocery store. They have their aisles where they have the packaged foods, but again, all those packaged foods are, for the most part, they are, organic. They are gluten-free or paleo, targeted towards different diet types. And Sprouts is just a little bit brighter. It's just a little bit cozier feel when you're in the grocery store. That's at least what they're aiming to do. And of course, they have normal operations like butcher and their bakery, seafood, etc. So I want to talk briefly about their CEO, Jack Sinclair. I was digging into the company just recently, and I found this video of their CEO, and I watched other videos of Jack Sinclair. You can tell that he has a true passion for the grocery industry. He's the former chief of Walmart Groceries, so he has a very good resume. So let's just listen into this little clip that Jack Sinclair was speaking at a recent event a couple months ago, I think, and just listen to him talk about the grocery retailing space.
I love the fact that customers are becoming more interested in their health and more interested of the impact that food is having on their on health. And I think the aspiration for the industry for me would be how can we accelerate the process of actually putting better food in front of people, better quality food in front of people, better fresh foods, better meal solutions, better private brands around some of the attributes that matter to customers going forward. And the fact is, for me, is there's too many grocery stores in America. There's not too many health and nutrition and health-focused stores in America. And as we see that, when we go next door to other health stores, the market just grows. And so the fact that we're putting so many stores in the ground, it'll allow us to access those customers who are interested in this space. We're going to build 30 stores this year and probably a few more the year after that. That opportunity to reach new communities and new customers is probably the thing that gets me most excited.
All right, so now let's look at their revenue. And you can see the trend here. I've done quarterly in the black line and the 12-month rolling average of revenue in the green. Obviously, during COVID, they had a little bit of a pullback in revenue. You can say from a lot of different reasons, but you can look at the historical on the right there, the historical track record of revenue growth, the 3-year growth, the 5-year growth, and the 10-year growth. Obviously, revenue growth is slowing a little bit as time is going on, but I think the 3-year and 5-year are highly impacted by that COVID dip. So I'm looking at the general trend, and it's a pretty straight line. It's pretty forecastable. So it's about 10% per year growth over the last 10 years. including that COVID dip. And so my forecast for the future in the near term is a 9% per year growth. In the longer term is 6% growth in that 10 to 20 year future. And I think their terminal growth is 3%, meaning I think this company is going to be around for a long time. I think that they're building a good foundation, and it's a grocery chain. I mean, it's a food service. It's not going to die. It's not a business that's going to die. And I think there's a good secular growth trend to the health food market, the health food space. And I think that this company is going to be around for a long time to come. And they're going to grow slowly in the long term future. So let's then flip over to net income. You can see the quarterly again in the black and the 12-month rolling average in green. A very well growing company. During COVID, they spiked up in terms of net income. They've come down a little bit as inflation is set in. It's tougher to sell products and keep rising your price to a company. So they're going to have a softening in net income to fill the gap as long as they feel like they can retain their customers. The growth there for 3-year, 5-year, and 10-year growth on this company in net income is 25% per year. If you look over the last few years, it's closer to 10%. So my forecast for the future is in the near term for them to grow 10% per year in net income, and to grow in the longer term 5% per year. And for terminal, the growth rate to set in at 2%. 3%, 2%, those are the highest terminal growth rates that I ever use. But that's for a company that I think will be around for a long time, has good trajectory for growth, and they serve some sort of consumer need that won't go away, groceries being one of them. Last but not least, let's look at their free cash flow information here. The trailing 1-year free cash flow is in the black line. Again, I smooth it out to a 2-year average annualized free cash flow because free cash flow happens in big swings. So you'll have a company will invest a lot of money 1 year, and that will draw down their free cash flow in capital expenses, and then in other years they won't, in other quarters they won't. So when you smooth that over 2 years, you're both of these lines are looking at annualized information. The green one is just smoother. You can look at the growth trend there. 3-year, 5-year, and 10-year, I have about 10%, 22%, and 9%. So my forecast for the future is for this company to continue to grow their free cash flow 10% per year in the near term, 5% in the later term, in the longer term, and they're 2% for the terminal growth rate in free cash flow. So those are my assumptions for those three, and I'm going to combine those three, revenue, net income, and free cash flow, when I do my valuation of the company, when I forecast future free cash flow and discount it to today's price. But before we get into that, let me talk about shares outstanding and a couple other things here. The foundations of the business I think are also important. You can see that the shares outstanding back in 2015, 2016 even, were up around 150 million shares. And ever since then, they've had a nice, steady share repurchase program that paused a little bit during COVID, but they've continued to buy back shares recently, including in the most recent quarter where they resumed their share repurchases. They ticked up a little bit in Q4 of 2022, but they resumed to repurchasing shares in Q1 of 2023. And if you look at the previous 10 years, their decrease in share count is 2% per year. But if you go back to the 7 years where they started their repurchasing program, they're repurchased 5% of their shares per year on average. So decreasing shares helps grow our stake in the company if you're a shareholder, and it increases your returns, it increases your share of the pie, so that's a good thing. But we obviously don't want a company to be repurchasing their shares if their stock is overvalued. So we think we have a 10 to 15% target and the stock is undervalued based on that criteria, then that's a great opportunity for the company to deploy capital. It's a great way for them to benefit their shareholders at a high clip, a high return. So that's great. Looking at their per share metrics then, combining what we saw before with their share trajectory, their free cash flow and net income, you can see, have grown even faster than in nominal terms. So right there on the right, you see in free cash flow, they've grown, free cash flow per share, they've grown 21% per year going back 10 years and 28% per year in the last 5 years. And with net income, it was 16% per year over the last 10 years and 15% per year over the last 7 years. So interesting stuff. This company's doing really well. These are really good numbers. And you can see the consistency of that trend line. It's not going way up and way down. There are some fluctuations, but man, that's a good looking trend if I've ever seen one. Now let's look at return on invested capital. You can see the purple line is their return on invested capital. I drew a black line at 10% to show that's kind of my gauge for whether a company is really solid as far as deploying their capital to get returns or just normal or below par. So anything above 10% ROIC to me is awesome. And this company has lived in that 20% range for a while, and recently, since COVID, they've jumped up to 30. Now they're trailing back down towards 20, but I think this is fantastic return on invested capital. This shows that the management knows what they're doing. They know how to expand their business and to grow their business really well. So kudos on the ROIC, thumbs up going forward. Let's look at their balance sheet really quickly. You can see I've highlighted their total assets at about 3.1 billion and their total liabilities at 2.1 billion. But I scan through this balance sheet, I look for other things. What's their cash on hand relative to their current debt? What is the ratio of their intangibles to their total assets? I don't like when companies report high goodwill, high intangibles brand value, because I have no way of trusting what that is. I like tangible assets. So I scrub the intangibles from the assets when I develop this quality asset category. So I also take away some of property, plant, and equipment, because we all know that you can report property, equipment, but if you were in a fire sale and the company was going out of business, you won't get 100% of that money back. So I shed some off from that. Those could be inflated numbers based on the economy and whatnot. So in essence, yes, they have $1 billion about in net equity. However, in net quality assets, after my little process of taking a look at things, I say 372 million, which is about $3.54 per share. If we were to use just the raw numbers, it'd be closer to obviously, $10 per share in balance sheet value. So that's a big difference. But I like to be on the conservative side. But I love the fact that they have $300 million in cash on hand compared to their $500 million in debt due in the next year. I mean, they could pay down all their obligations just with the cash on hand, not to mention the free cash flow and the receivables that they have. But something else that I like to see there is like 10% of your total assets in cash on hand, to me, is awesome. It's rare to see companies that have that much of a ratio. There's other companies that are a lot better, but you don't want to get to a point where most of your assets are cash on hand, because that shows you're not investing your money. So this to me is a good balance. It's not the best balance sheet I've ever seen, but it shows that the management knows what they're doing. They're handling things okay, and at least we have a positive net equity, even when I do my conservative adjustments. Now let's look at the business pillars of the company. This is my pillar system that I use. I mean, I have price ratios, free cash flow, debt, net income, revenue. The dividend has to be lower than a certain portion of their free cash flow, which in this case, the company doesn't have a dividend, so we give it automatic check marks, but that ROIC is in there. All things considered, this is checking off tons of boxes on our pillar system, meaning that this company is steady, it's predictable, it doesn't fluctuate a lot, and it has basic foundations of the business, like the return on invested capital, that are very positive. I highlight a couple things on this page, like a couple of the X marks that we have are 7, where the criteria is net income increased 8 out of the last 10 years. Well, that's a near miss, or a close miss as I call it. And so if that's a check mark, then that whole net income portion gets a check mark. So we're almost sitting right here at 8 out of 8 check marks on the main pillars, and 18 or more out of the 21 sub pillars. So to me, that is awesome. This is among the most fundamentally solid businesses at the current time that I evaluated. So it's up at the top of that list. Now let's look at the valuation. This is the result of my discounted free cash flow model, which simulates the company's future 10,000 times. So out of the 10,000 simulations, that chart right there is a histogram. How many iterations fall? what's the frequency of the fair value of the company falling in each bucket. And I put an orange line there. The prices are on the x-axis there, the price buckets for fair valuation. I put a line where the current price of the company is at $37 a share, somewhere about there. And you can see the highest frequency is for the company to be evaluated between $39 and $46, that bucket there. But you also have a significant number of results that trail upwards from $46. So when you combine everything, we get averages. Now, that is based, that fair value distribution there that you see on the histogram is based on a safety factor valuation with a 10% target. So you're seeing the 10% discount rate applied with a 1.2 safety factor. That is the fair values of everything, divided by 1.2. The current price of $37 a share is right at the 37th percentile at a 10% discount rate. So if your target's 10%, then anything less than 50 percentile should show that that's undervalued, or that's underpriced rather, relative to its value. So you would want to buy that if you were trying to get a 10%. And I've sort of backtracked the calculation there and derived an anticipated rate of return of 13%. So that's the big headline number. Like, if you were to buy at the current price, you should anticipate a 13% return in perpetuity. The fair value there table at the bottom, I have 10% low, medium, high, and 15% low, medium, high, and you can see the ranges there. When we use a 10% discount rate, we're looking at $45, $50, and $55 in that range as fair value. And if we use a 15% rate of return or discount rate, it's closer to that 27, 30, 33, so $30 a share. So $50 a share, $30 a share. When we average it together, the fair value in a 10 to 15% range is, to me, $40 per share. And the current price is $37 per share. So that's the result of the valuation analysis I've done. So in summary, this stock is close to its intrinsic value of $40 per share, or abouts, for a 10 to 15% return target. And the anticipated return, if you buy at the current price, is 13%. So if that's a return that you can live with, which that's a great return to me, then you should probably buy this company now. However, just be aware, because the stock has tracked up in recent months, so we could be looking at $40 per share coming up quickly. You just want to have in mind when you want to sell this company. If you're holding it above $40 per share, you have to come back and look at these numbers and make sure that you're still above that 10% threshold, if that's your target, or where you fit. I mean, you might hold this to $45 a share, you might hold it somewhere between there, so that's up to you. I think this is an A-plus quality business. It's got great fundamentals, it's got great management. The balance sheet is not the best I've ever seen. It's not brilliant, but it's okay. It's a good balance sheet. The company does not have a dividend, so if you're a dividend investor, this one isn't for you. This is going to focus on increasing store count and same-store growth, which have both been positive in the recent years. The food business, to me, is a resilient business. We're coming into a recession, we're coming into inflation, but guess what? People don't stop buying groceries. On the margins, these health grocery stores are going to have maybe a few people switch back to discount retailers, discount grocery stores. However, the bulk of the customers who are interested in health foods, who are interested in the product that Sprouts sells, those core customers, they're going to keep coming back. In fact, most of them, they're pretty well off. I mean, they are not going to cut back on their grocery budget. They may cut back on other things, but they're going to have the money to withstand the downturn. They're going to have the money to withstand inflation, and they're going to pay the higher prices. On the margins, yes, they'll trim down, but overall, grocery business is a fantastic business to be in. I believe there's a great tailwind with the healthier food movement, which is going to continue. Younger people are into healthier foods. You can't get around it. And the younger people are moving in, the millennials are moving into that grocery store buying phase of their life. And I think that this is just going to be a broad growth trend that's going to help Sprouts Farmers Market. So in summary, I give an overall rating of 8 out of 10. So this is in the top 15% of companies that I've personally evaluated. It's a great company. The only reason it's not a 9 or 10 out of 10 is because it's sitting so close to that fair value. It's still underneath, but it's only got a little bit of room to run. But if you're okay with a 13, a 12, an 11% return, I would buy this stock and hold it into that $40 range, into that $45 range. I currently own Sprouts Farmers Market. It's part of my main portfolio. I'm going to hold this thing. We're going to see. I mean, I'm going to reevaluate after it hits $40 a share, if it does. And if it doesn't hit 40, I'm just going to keep buying slowly and holding on to my position in Sprouts. This is a long-term hold. It's a great company. And that's it for my stock valuation, my stock analysis of Sprouts Farmers Markets. If you appreciate this video, if it helped you out at all, please like this video and subscribe for other stock valuations. I have a couple other stock valuations here you can watch. Otherwise, have a great day, and I'll see you next time.